to The Retirement Architect. My name is Cynthia DeFazio, and I'm joined today by David Reyes. And David is founder and chief financial architect of Reyes Financial Architecture. David, it's a pleasure to see you again. How are you?
I'm very well. How are you today?
I am doing fantastic. Thank you so much. How's life been for you at the office? I know busy.
Busy, yes. 3 kids busy, and then luckily my kids have been going to school, so that has not been the case with all schools. So we've been very blessed to have that. So yes, busy in every way, shape, or form.
Sure. Let's talk about your 3 little ones for a little bit. How old are they now?
My youngest son David is 6. My middle daughter Taylor is 11 and 17.
Wow. So
the
it's
problem
a
teenager.
busy
No,
house.
she's not. She's great, but no, no
17.
teenager.
So
yeah,
driving?
17. Driving, yes.
Okay.
She's doing good, yeah. A little nervous, but no, she does it good. She's good. We're lucky we have good kids. So
yeah, I can see why. You and Julie are amazing. So.
Yeah, well, thank you. It's a labor of love, like my work, your kids, right? That's the things we can leave behind. So, no, they're good. Thank you for asking, but they're all doing really well and healthy and happy, and that's all we want, so that's great.
Absolutely. So we've talked in the past, obviously, the importance, and the topic of the show is planning for retirement, having a proper plan in place, if you will. Is it still a staggering number of people, David, in your opinion, that do not have a true retirement plan when they hit their retirement years?
I mean, the way we do retirement planning, I would say almost nobody that has one that comes to us, because I've asked you, how much tax are you going to pay in retirement? How much income can you afford to take out without having to run out of money? Have you accounted for inflation? Those types of things. Very few people. We've talked about written plans. We do written plans for all of our clients, and I probably have less than a dozen clients ever come to me in 25 years with a written formal plan. Yeah. So most people don't have any type of retirement plan. Now, they'll say, well, David, that's not true. I saved my money in a 401k plan. I'm talking about a retirement income plan, right?
Sure.
So people might have a pension, they may have Social Security, they may have savings. But we have not only does planning have to be implemented, it has to be integrated. Okay. Right? We have to integrate. What is the optimal time to take Social Security? How should I invest my money to make sure that I have enough income so I can protect the downside against stock market volatility? What's the best way to diversify? Should I own real estate as an asset class? Should I own annuities? All these things. And so unless you've kind of turned over all those rocks, which we do every day, and you have it written out, here's what I'm doing, here's what I can do, here's what I can spend. And the fun part is a lot of people can actually spend more money than they think they can. So really it's not always like the doom and gloom, it's actually the opposite. A lot of people are happy that they can spend more money than they thought they could, and I call it giving permission. It's some people need permission. We've talked about some other shows to spend their own money. Sure. So what we can do is be a catalyst to help, which makes me happy. Being selfish about it, right? I want to be happy too, right? For you, sure. Is the fact that we can help people to spend money that they wouldn't normally spend. And a lot of that comes down to how do we have a plan that creates income instead of just having to sell mutual funds or sell assets, because people get nervous when they spend their whole life saving those $1 million, and then all of a sudden they need $50,000 a year, and all they say is, well, David, so every year my portfolio is going to go down? That's not necessarily the case. So all the things, we want to make sure we have enough income in retirement, we have inflation, taxes, but also we don't run out of money. Sure. In a perfect world, we should have hopefully the same money we had when we started or more money. Not everybody can have that outcome, but that's kind of what we shoot for. We want to have, how do we create income from a portfolio? Not just spending down. You don't need me to spend down your portfolio every year and say, okay, I have $1 million, and if I spend $50,000 a year, I can do the math. I have 20 years to live and to spend my money. And so we want to have a lot of, it's multidisciplinary. It's taxes, inflation, it's income planning, investment planning. And so you have to incorporate all of those to really have a comprehensive plan. So people just don't have that, and it's not, it shouldn't be expected anyway. I mean, it'd be shocked if, and again, 1 in 100 do, and that's great. But the majority of people don't, and they need the help.
Absolutely. How does this correlate with the 5% rule, David, if you don't mind me asking? Yeah,
so we have a term we call the 5% solution, and what that is, not earning 5% every year. What we want, what we know through experience. Morningstar, who's a big data aggregator of mutual funds and things like that, and they say basically a safe withdrawal rate is 2.8%. Okay, back in the 90s, it's called the 4% rule, right? You can take out 4%. Well, now it's less than 3%. Now it's even lower, in my opinion, because number one, you have bond rates that are lower than they were even a year ago, and you also have inflation that we didn't have before. Okay. So if you really want to look at it, it's probably ridiculously low. I haven't recalculated, but it's probably around 2.5%. With a normal portfolio of stocks and bonds, a balanced quote portfolio. And so our 5% solution, what we do is we're saying, how do we create a 5% cash flow from the portfolio? To give you an idea, if you have a half stock, half bond portfolio, I can tell you, you're probably getting about a 1 to 1.5% yield on the portfolio. The dividend yield on the S&P 500 right now is 1.5%. Meaning if you own a stock mutual fund, it's going to pay a dividend at about 1.5. If you own bond mutual funds, you're going to be at a yield of probably similar, about 1.5%, 1 to 2%. So 1.5% of the entire portfolio at $1 million is $15,000 a year.
Okay.
I can tell you we need about $50,000 to adjust for taxes, to adjust for inflation. Because remember, every dollar that's taken out of a retirement account is taxable.
Sure.
So the problem is that what people are invested in, how they're invested, is not going to. It's just we have the wrong strategy to get to a result that we need. So unfortunately, the stock and bond market are really working against us in a lot of ways when it comes to cash flow. So part of the 5% solution is, how do we create 5% income? So if I'm going to own equities, I talk about dividend stocks. So we want to own stocks, let's own dividend stocks, get paid cash flow. Our dividend portfolio pays a distribution rate historically of about 5%. Okay. We may want to use some guaranteed lifetime income product that pays, let's say, a 5 or 6% distribution rate for the guarantee for the rest of you and your spouse's life. Maybe we use real estate as another asset class. We've talked about real estate in the past. Typically, we're looking for a 5-6% distribution rate. So if we now can take that $1 million portfolio and now reshape that and say, okay, let's add some other asset classes in there. Now we can get closer to what we want to get, that 5% solution. Instead of having a 1 to 2% distribution rate on our portfolio, let's get 5. Sure. Now we can be in a position to where we can really have the retirement that we want. But again, that takes work, it takes time, it takes energy to do that. And it takes education. You know, when I go through these processes with prospective clients, I mean, it's usually 2 or 3 meetings at a minimum to get through this, because I got to teach them first. Here's what you got, first and foremost. What does it look like? Right, it's like a house. You can't, it's buying the one house you looked at. How do you know, right? Got to look at other houses. So what do you own first? And then how do we assess what we have, what we like about what we have, what we don't like about what we have, and what are some other better options that can either add to what we have, or maybe we need a total redo of what we have, what we've invested in. So typically it's pretty dramatic changes that need to be made. Again, want to focus on protecting capital, creating lifetime income, and having conservative growth of the portfolio. So it's something that takes a lot of work effort, but it's fun, and the clients really like it, because in the end, the light bulb goes off and they get it. They usually say, David, why has nobody ever taught me this before? Things like that. And I think unless you're focused specifically on retirees, you're just going to focus on, here's the portfolio, a balanced portfolio of stocks and bonds, but that doesn't satisfy the needs that I think the clients need relative to having safe retirements. Sure, and again, it's all customized to that specific person that's in your office, all personalized. So this is the perfect time for us to go ahead and open up the phone lines. Would you agree? Great, thank you.
To the viewers at home, the number to call is on your screen, and it's 866-739-3775. What David is offering you today is a complimentary consultation. If you have $500,000 or more in investable assets, this is a perfect opportunity for you to come in and make sure that you're in the right retirement plan. Make sure that you can have the retirement of your dreams. The number is 866-739-3775. Due to limited availability, we only have 10 spots open this week. Again, it's 866-739-3775. We'll be right back after this very short commercial break.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have. By running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no-obligation, full-blown financial review today.
Welcome back to The Retirement Architect. My name is Cynthia DeFazio, and I'm joined today by David Reyes. And David is the founder and the chief financial architect of Reyes Financial Architecture. David, a great first show, obviously first segment that we're having rather. And I love watching the phone lines light up. The viewers are so excited. They want to have that complimentary consultation with you. And we were talking on the commercial break. I'm amazed at how long it takes you to put a plan together. Let's talk a little bit about that and what this value is, because really it's quite astounding what you're doing for folks.
Yeah, we kind of talk about it off the cuff, but I mean, it's a serious, I would say the average to go through the time it takes to get to know somebody, to teach them, you're talking probably generally about 6 hours worth of meetings.
Wow.
And that can be 2 to 3 to 4 meetings depending. And that's not including work that's done, outside of those meetings, which is done. So it's significant value. It's not here's your portfolio, here's our great strategy. No.
Yeah.
It's, again, begin with the end in mind. What do they need? What is the cash flow that they need? What's the risk? All that. How do we build the portfolio? How do we build the income plan? What are the taxes going to look like? Is there estate tax issues? Is there long-term care issues? Those are big, giant questions that have to be dealt with the way we do the planning. So it's a real plan.
Yeah.
We used to charge thousands of dollars to do this, but over the years, I found if a client goes through the process, there's a probably pretty good chance that we'll work together, kind of through osmosis, right?
Sure.
Because our philosophy is not going to change. We want the most amount of income, the least amount of risk, and never run out of money.
Sure.
Most amount of income, least amount of risk, and never run out of money. And so with that being my job, if we're on the same page with that, then it becomes apparent if somebody is going to hire us or not. But it's not required. It's complimentary.
Yeah.
So if they're open, I'll go through the process with them. It's fun. They'll learn things. I always promise they'll learn things that they had no idea they knew of that were possible.
Sure.
And typically it's a positive. These are things we could do we didn't think we could do.
That's amazing.
So it's fun. Otherwise it was depressing. Oh my gosh, you don't have any money. You don't have, no. It's usually a positive conversation. I wouldn't enjoy my job so much if it wasn't such positive outcomes and clients discovering, retirees discovering that they can do more with their assets than they thought.
That's fantastic.
With less risk typically, which is kind of the key.
Yeah, absolutely.
So yeah, thanks for asking that. And so we're proud of the process. We're proud of the value that we give to clients. And again, we don't charge to do, we'll do the fee analysis. Most people are paying too much in fees. We do the risk assessment.
Yeah.
Most retirees have way too much risk, especially today with what's going on with the stock market, and just don't have any type of retirement income plan. So, those three things alone, including my partner being a CPA, we have our own in-house estate plan attorney. You add that up, it's a lot for most people who have never gone through that kind of process to really, look at their portfolio and their taxes and their trust and all that. So it's a value, and it's needed. To me, it's required.
Absolutely. And again, it goes back to the benefit of working with a fiduciary as well. We have to talk about that because in case someone in the viewing audience is just watching for the very first time, David, let's talk a little bit about what that means to them and why it's a benefit.
Yeah, being a fiduciary is important. So think of like an attorney-client privilege, or a doctor, a Hippocratic oath. A fiduciary has a legal standard of care, a legal duty to put your interests ahead of their own. Yeah. Just that simple. Where in the brokerage community, sometimes in the insurance community directly, there may be a suitability standard, but there may not be a best interest standard. Now they're making some changes with that, which I think are long overdue. I don't think there should be a distinction. If somebody's talking to you about your money, they should have your best interest at heart.
Sure.
Unfortunately, that's just not the case. They're trying to push that forward. But at least with us, our clients know that we have a legal standard of care. It's a moral duty. So we've put ourselves in that position as a check and balance to make sure that we're always doing the right thing. There's no conflicts of interest. If there are, we have to disclose them. We don't have any firm conflicts of interest.
Okay.
It would mean that we do something that's on the side that we make more money doing. No, none of that. So everything is disclosed. It's fully transparent. Fees are transparent. Whether we're looking at investments, we're looking at annuities, whatever investment we're looking at, we have to put that client in the best product, best strategy possible, least amount of cost, all those kind of things that go into play. So it's important whether somebody's looking to hire us or somebody else, make sure that they are a fiduciary, that they do have a legal duty, a standard of care to put your interest ahead of their own in the firm.
Absolutely. Let's talk about your communication style, David.
Yeah.
Once someone decides they want to be a client of yours and vice versa, you decide that you're a good fit together.
Yeah.
What does that look like going forward? Is it something, are you in touch with them quarterly? How does that work?
Yeah, so good question. So after typically we're doing a 2 to 4 meeting process to go through, let's say 3 on average to get through the education, beginning to know them, putting a plan together. So we get to know each other quite well through that process. And then it's kind of like a wheel. It's just kind of going, monitoring, depending upon where they're at. If they're pre-retirement and they're not retired yet, there's going to be a lot more probably with that. When somebody's already retired, it's a little easier. But as far as communication with us, we have a rule. We'll see clients at a minimum once a year at a minimum. But typically it's about twice a year. Some clients I do see quarterly. Most clients just don't want to see you that much. Like I'm happy to see clients as much as they'd like to see me, but people are busy. As long as they can go online and see their account and make sure they're on track. We do a lot of ancillary communication with webinars that we do. I do a lot of market updates. If something's happening, I communicate a lot. So communication is not an issue for our clients. We have a rule. I talk to everybody at least that day within 24 hours. So if somebody calls me, it's typically that day I'm talking to them or the next day at the latest.
Sure.
And that's just something I'd want to have. So communication, I don't think we've ever had a complaint about communication.
I love that.
And so, but people do. One of the biggest complaints that new clients will come to me and says that my advisor just doesn't communicate with me.
That's why I was asking. We hear that quite often, that people, especially last year in 2020 when there was so much going on, they didn't hear from their advisor at all. That's a huge red flag.
Well, it's kind of bullets flying, they're headed on the desk, right? When the portfolio is down 30, 40, 50%, I mean, we're just not going to be in those positions. Managing money conservatively for 25 years, we're not going to be in the position to where we have those kind of losses. I mean, I got no phone calls during the first quarter of 2020 relative to the market crash.
Wow.
Because our clients didn't have issues with their portfolios. They weren't concerned, concerned about the market, but nobody called us panicked or worried because they saw their portfolio values were intact, at least reasonably. And that's not always the case. So what happens, human nature, you've got a problem, and as an advisor, maybe that's difficult conversations to have.
Sure.
And so part of the way we built the firm is to align ourselves 100% with our clients. If you're concerned about risk, I'm concerned about risk, right? So there shouldn't be a disconnect there, right? So if the market's down 35% and you're down 35%, we didn't do our job. Our job is to manage the risk of the portfolio, create the cash flow that we need. So, I'm not going to have those kind of situations to where I have to be concerned about not want to talk to somebody because I have bad news. Life's going to throw curveballs, no question. But the fact is, in general, if you can avoid, as part of our 7 principles or 7 rules of successful retirement, is avoid large losses. It's number 1 in our rules. So if that's your number 1 rule, you're going to want to be not exposed to that type of market loss, which will cause those types of anxieties that we have in portfolios that we don't want to be part of.
I know your clients appreciate that so much about you because you have more of a conservative approach, especially in the retirement years for your clients. And a lot of times I know you have people that are coming in and they're looking at you and they're saying, David, you know what, I am moderate risk. But you take a look at their portfolio and you're like, no, you're really high risk. Is that happening quite a bit?
Yeah, and even more so now, even because somebody had the same risk they had even in last year when the market was going down, and now the market's a lot higher. So I would equate even their risk is higher today than even it was then. The market's further, it's farther, it's gone faster, higher, all those things. And the fact is that we look at risk on a more absolute basis. So what does that mean? So if the market's down 30%, right? And advice says, well, you're only down 25. Well, you didn't do your job, right? I want to look at this stuff. I want to be in the 10 to 15% range as a max loss ever. We talked about upside, downside capture. So if I only want to have half the downside of the market was down 30 and I'm down 15, I can live with that, right? That's more absolute risk management, not relative. The market's down 35, I'm down 29. No, we didn't really do a great job. So we're looking at more, how do we manage risk to an absolute basis? So the only way to really do that is you have to have, tactical money management. So it's part of the way we manage money. We're in the great San Diego, California, our backdrop here of the marina in the bay is, a lot of sailors, right? So people understand sailing and rowing, right? When everything's perfect, you just sail, right? Like the market's been a bull market. Well, sometimes you need to row. Right, so think of rowing like a tactical portfolio. We need to tack, And so we are doing both. We want to be the ability, the only way to protect downside risk is through one of the ways with equity markets to have a tactical approach. And so a lot of firms just don't implement that. And so there's a lot of ways above and beyond what typical portfolio risk management was usually going to use bonds. We can do other things using guaranteed lifetime income investments, principal protected investments, using real estate as we've talked about, using more tactical strategies to actively manage risk. You put that all together, then you can have a portfolio that you don't have to worry about when the stock market's crashing. Everything you're doing is not tied to the market, and you also have some active risk management. So we're doing everything, I call it belt and suspenders. What can we do to hold the ship afloat?
Exactly.
Right. And so the fact is that again, that takes time, experience, dedication. I'm just obsessed with managing risk because it's just I've found over time if you participate in the upside but don't participate as much on the downside, we talked about 60-40. If you get our 60-40, you want 60% of the upside and less than 40% of the downside. You'll have good returns that way instead of getting 100% of the upside, 100% of the downside. So knowing that, that's how we're going to manage money, and that's how we're going to make people feel comfortable and not be able to sleep at night during these market tensions, which we're going to have again. I think we'll have them sooner than later, but they're going to come again.
Sure. Well, David, this is the perfect time for us to reopen the phone lines to the viewers at home. Would you agree?
Sure.
Okay. To the viewers at home, the number on your screen to call is 866-739-3775. What David is offering you today is a complimentary consultation. If you have $500,000 or more in investable assets, this is the perfect offer for you. So please don't miss this opportunity. 866-739-3775. We only have 10 spots available this week, so please, 866-739-3775. We'll be right back after this very short commercial break.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
And welcome back to The Retirement Architect. My name is Cynthia DeFazio, and I'm joined today by David Reyes. And David is the founder and the chief financial architect of Reyes Financial Architecture. David, a great show that we're having today. And again, I love watching the phone lines light up. I know people are just wanting to have that information and that consultation that you put so much time into, and they're so excited about that. We've also had viewer questions, and so we probably have time for maybe one or two today, but do you mind if I throw one at you?
That'd be great, yes.
Okay. This is a great question. It says, David, I have a question about a Roth conversion. Is it difficult to do a Roth conversion on an IRA?
Yeah, so a lot of terminology in there, right? So what is a Roth conversion first? So a Roth conversion is where you have an existing taxable IRA or 401k and you move it to a tax-free account, which becomes a Roth. And now it grows tax-free compounded. No requirement of distributions, it grows tax-free. Great. The negative is you got to pay taxes to do that. So is it difficult? No, it's simple. All we're going to do is set up another account. Okay, you have your IRA here. We use Charles Schwab as our custodian, so we're going to have another Charles Schwab Roth IRA account. We move money from this account to that account. That's great. Everything's hunky-dory. It grows tax-free. The difficult part is you got to pay tax on the conversion.
Okay.
And so to give you an idea, let's say you're in a 20% tax bracket. and you moved $100,000 from your one traditional IRA to a Roth IRA, you're going to have a tax bill of $20,000. So there was a lot of planning that becomes involved with that. What do we pay for it? What's the amount that we want to contribute to that Roth conversion? I'm a big proponent of Roth conversions. We have the lowest tax rates that we've ever had, really. So if you think tax rates are going to be higher, we should have a plan to move some of those assets over the next several years. We'll do formal plans. We'll say, okay, we're going to do $50,000 a year, $10,000 a year. It's all going to be tax-based, though. What's the tax? And we're going to plan around that to mitigate the taxes we pay to move those monies into that tax-free account. So there's a lot of planning that's involved with that. If you want to do it the proper way, there's what's called bracket creep. We want to make sure we stay in the lowest bracket, because maybe we're $1 above, we put another dollar in, we're now in another higher tax bracket.
Wow.
Maybe we went from a 25 to 30% bracket.
Yeah.
So there's all kinds of planning that we can do around that. If you're a business owner, there's certain, maybe you have net operating losses, there's other things that you can write off to mitigate or eliminate the tax on conversion. So they can get pretty sophisticated. And again, my partner's a CPA. We do a lot of planning on the tax side with business owners, with retirees, doing Roth conversions. There's lots of ways with after-tax dollars to do a lot of tax planning. So if you have taxable money, there's ways to mitigate the taxes, ways to eliminate or reduce the taxes on those assets. So that's a big component. Not everybody needs high-level tax planning, but there's enough clients that it's an important part of our practice for clients.
Sure, and there's definitely a difference between tax preparation and tax planning.
Yes.
Let's talk about that, because a lot of people are like, oh, I have my taxes done every year. But when you're looking at a plan for someone, tax planning is very important. You're not only looking at the calendar year, you're looking at years going forward, correct?
Well, it's kind of like, do you want to score keep? Well, tax preparation is scorekeeping. It already happened, or I want to win the game. Right. So I want to be a player. I want to win the game. So we need to score keep. But the fact is, we need to have the players and team in place to help us win. And that's having doing everything legally, ethically, morally, viable to help our clients to pay their fair share of taxes.
Sure.
And so for some clients, it can be significant. A lot of planning can be significant. For others, it may not be. But at least we're in a position to help clients to be able to observe that and say, hey, this is an issue, this is an opportunity, and so the fact is that we're built to handle that and to help people to mitigate their taxes and again pay their fair share. Okay,
David, we have a minute left in the show this week. Any final words of wisdom for the viewing audience?
Words of wisdom would be do planning today, right? We had a caller this weekend on my radio show, and they were nervous because they were 5 years out, right, from planning. Mm-hmm. I'm like, look, you're 5 years ahead of everybody else. So if you're thinking about reaching out to get a second opinion, just do it. Promise that you'll learn things you just didn't know that you didn't know, and those are the things in life that typically hurt us. So I'll share those thoughts with you in 25 years of experience. Perfect. Well, David, thank you so much for another amazing show. To the viewers at home, most of all, thank you so much for watching and for those questions that keep coming in. We love having those questions. The number is 866-739-3775. Thank you for spending time with us again this week. Be safe, be happy, be blessed, and we'll see you soon.